The Qualified Opportunity Zone (QOZ) program provides tax incentives to invest in designated low-income communities across the United States. Tax law changes enacted last year made the program permanent and altered it, with implications for investors under both the original and renewed programs. With proposed and eventually final regulations on the way, the IRS has released some transitional guidance for investors, Qualified Opportunity Funds (QOFs), and Qualified Opportunity Zone Businesses (QOZBs). QOZ Basics. The QOZ program was created by the Tax Cuts and Jobs Act, TCJA. It generally allows taxpayers to defer and possibly reduce or eliminate short or long-term capital gains from the sale of their investments by reinvesting the gains in a QOF within 180 days. QOFs must maintain at least 90% of their assets in QOZ property. Qualifying investments include those in QOZBs and in new or substantially improved commercial buildings in QOZs. Under the TCJA, the tax benefits from investing in a QOF are generous. Taxes on the rolled-over capital gains are deferred until the earlier of 1. The sale or exchange of the taxpayer's investment, an inclusion event, or 2. December 31, 2026. Investors receive a 10% step-up in basis for the investment after 5 years, so only 90% of the rollover gain is taxable. After 7 years, the step-up increases to 15%. Gains on investments left in a QOF for at least 10 years are fully tax-exempt. The One Big Beautiful Bill Act, OBBA, established a permanent QOZ program with rolling 10-year QOZs. The first round of newly designated zones eligible for investment will begin January 1, 2027. It's expected that about 6,500 new zones will be designated. The original QOZ designations generally expire on December 31, 2028. Under the permanent program, rollover gains can still be deferred, with a 10% step-up at year 5. At that point, though, the rollover gains must be recognized, and the additional step-up at 7 years has been eliminated. But the permanent exclusion of gains on the QOF investment itself after 10 years remains intact, for up to 30 years after investment. The OBBBA also created a new kind of QOZ for rural areas, with a 30% step-up on the rollover gain after 5 years. What's in the guidance? The guidance in IRS Notice 2026-40 addresses several issues of concern, including treatment of existing QOF investments. Investors who hold a qualifying investment through December 31, 2026 must include the amount of remaining rollover gain from the investment in their income for the tax year that includes that date. Notably, they can't defer that gain by rolling it into a new QOF. Existing QOF investors can opt to continue to hold those investments. If investors reach the 10-year holding period and satisfy certain requirements, they can elect to adjust the basis at sale or disposition to the investment's fair market value at that time, thus eliminating taxable gains after the date of the original investment. The treatment of gains on an inclusion event that occurs before December 31, 2026 differs from that of gains where the investment is still held on December 31, 2026. In the former situation, the recognized gains may be eligible for deferral by making a new qualifying investment within 180 days. But the clock on the 10-year step-up in basis will start over and run from the date of the new investment. Tangible property acquired after 2026. Under the OBBA, property acquired by a QOF or QOZB after December 31, 2026 generally can't be treated as QOZB property unless it's acquired for use in a QOZ designated after July 4, 2025. That means tangible property acquired after 2026 generally can't qualify as QOZB property if it's in one of the originally designated QOZs. However, the guidance outlines 2 exceptions that allow tangible property acquired by QOZBs after 2026 in an original QOZ to qualify. Working Capital Safe Harbor. The safe harbor applies if an entity acquires the property under a written working capital plan that was adopted before December 31, 2026. The QOZB also must have received at least 10% of the estimated working capital assets designated by the plan before December 31st, 2026, and expended at least 5% by that date. Ordinary course of business exception. This exception applies when a QOF or QOZB acquires tangible property in an existing QOZ in the ordinary course of its business to replace existing tangible business property, if other requirements are met. Covered replacements include the replacement or modernization of property necessary for the business. Property acquired to expand a business or transition to a new business doesn't qualify. QOZBs and QOFs that are active in existing QOZs should ensure they can satisfy one of these requirements before the end of 2026. Seize the opportunities. In addition to the above, the IRS guidance provides transitional rules, including safe harbors for how QOFs and QOZBs can continue to treat a location as if it were in a QOZ after an existing designation expires. Questions? We can provide further details on the new QOZ guidance and explain how it can benefit your tax situation.